thank you very much being here. I want to especially thank Alexandru that you have invited me. I don't know if you know that together with Alexandru, we both are sitting in the EIOPA stakeholder group, and the EIOPA stakeholder group in this year is very much occupied with a lot of regulations created by EIOPA, be it guidelines, be it technical specifications, and insofar we are very deeply in the process of preparing Solvency II. I think I've prepared a lot of slides. Some of them I will skip because you have already touched them. But I think it's good to have a view of, so to say, why Solvency II, then the risk approach of how we see it as a group, and maybe where we stand as a group and the challenges. Okay. The need for Solvency II, we have to be aware that Solvency I is a simple regulation. And this is on the one side very, very positive. You can calculate very easily and fast your solvency capital needs. On the other hand, some items simply are not covered, and maybe the most important one is that the asset risk is not covered, and that turned out, especially after the year 2001, after the attack to the World Trade Center, where we had a deep downturn in the stock markets, and that simply was not reflected in the solvency regime. We have seen that this discussion in Solvency II lasted for over 14 years. What I want to point out here is that in parallel, since 2005, for international listed groups, IFRS as a standard is obligatory, but it was not possible till now to create a standard for the technical provisions of insurance. Yeah, we have to be aware. We have a standard we should follow that does not exist. And that has led to the situation that we have a lot of different regulations that do not completely fit together. Out of that, in the 2000s, a framework for calculating embedded value has been created. This is insofar important because, as we have heard, Solvency II is a regime where you have a market value approach, and this accounts also for your liability, and insofar the embedded value calculation comes into the play. The ongoing procedure, will come back to that later. Maybe two remarks concerning the implementation phase 2009, when the regulatory framework, the framework directive was set. That was immediately after the financial crisis. And out of my view, there was a political need in Europe to set regulations. And that has insofar speeded up the process. But, and this is for me also very important, that has put us together with the banks somehow. And this is something what I heavily have to contradict. Because banking risks and insurance risks are completely different. Banks are normally short-term financed, and they are long-term borrowers. Insurance is completely the other way around. Insurance are cash collectors, and that means that, especially in a financial crisis that is a liquidity crisis, as from 2008 on it was, insurance is a stabilizing factor. What is also very important is that the insurance system has a very, very experienced way of mitigating risks that is experienced for over 100 years. That's called reinsurance. And in banks, you simply only have the derivative markets, and we know very well the role the derivative markets played in the financial crisis. So some other things concerning banks: by far bigger balance sheets, by far bigger part of short-term financing. Coming back to Solvency II and then to our group, what's the idea of Solvency II? The idea is simply that you should be able to stand a 200 years event. That means insurance companies should be able to survive 200 years. What's behind that? Behind that is something that was said today. Mr. Golovatic said, importance is trust. Trust is a basis for insurance. So you have to be able to fulfill your obligations, your promises after years, after in life and health insurance maybe 20, 30, 40, 50 years. And when it comes to 200 years perspective, maybe it's a good idea to look at our group. Because our group has been founded 1824, so it's a bit more than 190 years old, and there are not so many companies and groups that have survived nearly 200 years. And so it's a good example of maybe what you have to do from a risk perspective to be able to survive 200 years. I think it's very important that you are aware about your risks. That means, what is your business model? What risks you want to take? What risks you don't want to take? This, in our case, is important when it comes to investments. We have a conservative approach towards investments because we think the main risks we take are on the liability side of our balance sheet. What is also important is that you have a strong capital position that enables you to stand the risks over a long time. And this in Solvency II also directly comes out, it's important how you mitigate risks. I have already spoken about reinsurance, that's external mitigation, but very important is internal mitigation of risk, and that means diversification. And this is something which is a key focus of our group. So the strategic cornerstones for the business model, we are an insurer. This sounds simply, but not always is followed. There are lots of businesses, in our opinion, that are more appropriate for banks when it comes to credit insurance, when it comes to asset-backed securities, things like that. If you are not in that or not heavily in that, maybe that helps you in some crisis situations. You should focus yourself and your management attention where you think you are at home, and that's your core task, and that's for us Austrian CE. I will come back to the CE item because we are big fans of Central Eastern Europe. Maybe we are one of the biggest fan of Central Eastern Europe. We are very unique insofar because we have a multi-brand approach. That means we have a very decentralized steering approach. We think this is appropriate for insurance, and this increases our diversification. I will come back to that. And to do so, we have to rely on local entrepreneurial thinking management. This is maybe also a bit different to our other groups. When it comes to the investment sides, I think it's quite clear to have a conservative approach means for us quality, sustainability, conservativeness, and diversifications. What have we done? We have already had, before financial crisis, the biggest part of our investments in high quality fixed income investments. We have now concentrated even more on core Europe government bonds. We are also invested in conservative real estate, which we think from a cash flow perspective is very supportive for long-term liabilities. What I already said is a good business mix on the bond side, and what we have decreased, and that's maybe also an effect out of the financial crisis, is simply our exposure towards banks, because it has realized that banks maybe are not so stable than it seemed before the financial crisis. Next is capital position. You see here the development in the last year. It ends up with a solvency one ratio of roughly 250% in our group. That means an IFRS capital of more than 5.2 billion euro. And as we are talking about the risk-based capital approach, maybe it's also important to have a look at the rating side. Standard & Poor's is our rating agencies. Standard & Poor's is since many, many years following a risk-based capital approach. Also here, and maybe this you do not know, within the Standard & Poor's model, you have also some subparts. One of them is the capital adequacy, so meaning the capital buffer you have. And here, out of the last report, you can see that we are exceeding AAA, and AAA to exceed in the capital model of Standard & Poor's. There are only very, very few insurance groups worldwide to be able to do so now. Apart from that, we have a strong competitive position. I will come back to that. We have a strong governance and a strong risk culture. And then you will ask why we only have only A+. And then I have to come back to CEE. There are two things that Standard & Poor's always is arguing. The one is the country risks in the CEE countries. We are persuading them since now 15 years that these risks are overestimated, and for certain countries we have succeeded to do so. For example, Czech in the meantime is AA, but we are not on the end of the story. And the second item, and this is maybe also important for Romania, is that Standard & Poor's thinks that our earnings diversification is not broad enough. And then if we look at our earnings, of course, the biggest factors are Austria and Czech. Then we have Slovakia, we have increasingly Poland, but out of our big countries, Romania in the last years simply failed insofar. So this could be very supportive also if we could change that. Capital to have also is a question of capital management. This is the last capital measurement we did. We issued a subordinated bond this year, highly oversubscribed for a Solvency II, Tier 2 compliant subordinated bond. I think that's quite an excellent interest rate for us of 3.75 per year. So then it comes to diversification. Diversification for us, on the one hand, means regional diversification. You see here the market positions of our group. The dark red countries are the ones we consider core for us. This is a market of 180 million inhabitants. We have a market share of 19%. In there, that means we are by far the market leader. On the other hand, we define diversification also through business lines, through sales approach. We are trying to exploit as many sales channels as possible, and we are, as I already said, multi-branded. That means we are trusting in the value of our single companies. We are trusting in the management skills of the management of each and every group company. And last but not least, when it comes to diversification and earnings diversifications, and I come back to what Mr. Vrignot said, in CE, and here we see Romania, there is a lot of possible development in, and I think it is our task to exploit it. And when I say our, then I mean everybody here on the table, because it's not only the insurance industry per se, it's also a question of development of an economy. And I think Romania is on a good way from an economic perspective, and we should follow also on the insurance side. So what means that in concrete for the time being? We have since 2010 a debt crisis. Yeah, that means from the very moment on when it turned out that Greece maybe is not able to pay back its debts. We have out of that, negative impacts on GDP growth, negative impacts on the interest rate side, meaning an extremely low interest rate in Middle Europe. This is a 200 years event. The last 200 years, never ever the interest rates were so low than they are now, and that leads to a certain instability. How do we mitigate that with a robust earning structure, a sound diversification, and of course more and more asset liability management done in a prudent way is important. So coming back to the Solvency II item, and now I'm concentrating more on 2014 ongoing. We are now in the phase of implementation. We have, from the European perspective, a phasing in the different countries. It's differently regulated, but in the country where the seat of our group is in Austria, it's obligatory to have that phasing in. So out of that duty, but also out of our preparation over the last years, and we took part in the quantitative impact studies and are doing that stuff for a long time, we are already living the Solvency II world this year. And in 2016, it definitely will come into force, because that's simply said in an EU regulation that's directly applicable in all the EU member states. So it's law in all of the EU states. So Solvency II, it consists out of 3 pillars, and maybe over the first years of development, the concentration was on the pillar 1, meaning how much capital do you need, and the calculation of the capital. And we have heard a lot of discussions what happened after the financial crisis, of the calibration of the assets and how to work with the long-term guarantees. But that's only one part of the story. The second part is the pillar 2, that's the governance, the rules within the companies, the regulations you have to give yourself. And that's not, last but not least, pillar 3, that's the transparency, that's the reporting. This is quite a heavy task when it comes to investments, frankly spoken, to fulfill Solvency II. We have heard that Solvency II has not only a few risks to calculate like in Solvency I, but a lot more. You see them all here, starting with the different market risks and the technical insurance risks. What I wanted to show here is that we as a group are going for a partial internal model that covers the non-life part for our companies in Austria, Czech, Slovakia, Poland, and Romania. And we are going for a property internal model covering the companies in Austria, because by far the biggest part of our real estate investments are in those companies in Austria. We are planning to file for that approval in the mid of the year. We are in heavy discussions, and we are in an intensive preparatory phase that's now going over a period of minimum 3 to 5 years. When it comes to Pillar 1 on a group level, what we have heard in comparison to Solvency I, you have to aggregate your risk on a group level. That should avoid that you are using double gearing effects within a group. So out also from a group perspective, the solvency position should be sound. What I wanted to show here is that this is quite a complex story to do so. You can do that only with a sound IT support, otherwise you never ever would be able to calculate that properly in time. Pillar 2 is the way how you are doing risk management and how you govern within the group. Of course, you have the governance functions, you know, all the 4 governance functions that have to be implemented, internal audit, risk management, compliance, and actuarial function. And then you have a lot of policies that in our group have been already developed and are rolled out. You have to make sure that the risk takers are fit and proper. You have to make sure, as far as you're using outsourcing, that also here the regulations are followed. And you have, and this is something in our group we have implemented over the last years already, regulatory processes, meaning year by year risk inventory, meaning an internal control system with regulatory reports out of that. And maybe one thing I want to elaborate a bit closer is the ORSA, the Own Risk and Solvency Assessment. This is quite a mighty tool. It goes together with the whole planning effect in the group. On the one hand, you are trying to find out how your business will develop over the next 3 years. On the other hand, you estimate what, from a risk perspective, that means for you. Out of that, what for a capital perspective that means. But you also are analyzing if there are parts in where the risk you think that you are covering maybe is not appropriately reflected in the Solvency II regime, and therefore you prescribe of how it differentiates from that. So this is quite an important tool. I think we have done that for several times now, and end of last year, for the first time mandatory, not called ORSA at that time, but FIAR, because it was the forward-looking ORSA. In the end of this year, it will be the first regulatory mandatory ORSA. How we steer the group, we have a very decentralized approach. There are a lot of guidelines, of course, but within that guidelines, and this is, in our opinion, very important, Solvency II helps you to assess your risk. It helps you to find out what a good capitalization means. It helps you to find out if you have a good risk-reward effect. But in the end of the day, it's important that people who are steering the whole system are properly selected. I think the best risk mitigations are accountable managers. This is something what is very important in our group. So last but not least, reporting. Just to give you a flavor, you have those parts that go to the public, the solvency and financial condition report, and you have on the other hand the reports going to the supervisor, starting with the quantitative reporting templates. They are quite mighty. And as I've heard today, and I hope this will not turn out, that we have, in addition to that, local needs, because this is a huge extent already now, and it has many times changed over the last 3 years. And we have to be aware that each and every of these reporting effects creates a lot of IT work. And I think being in a position that we are now prepared for Solvency II for 2016, maybe it would be a good idea for the time being not to add something else. So altogether, this is quite a heavy work to do, because not only you have to collect the data, you have to validate them, you have to aggregate them, you have to put them in the format of the QRT. In the meantime, we have already tested the software provided by EIOPA and the Austrian FMA to transmit the templates to the supervisory authority, and then it ends up in the reporting per se. So I think we are well prepared. Of course, we are in time. Yeah, that's clear. There is a regulation. This is to be fulfilled. We will do it. And apart from that, we are prepared and that we are working on the internal models. We are now trying, and this is something what is important for us all, given that there are so many outputs of Solvency II, we more and more will use the additional outcome of that calculations for challenging our business itself. And I think this again is something that will bring us forward. This counts for us as a whole group. I'm sure when you're following Solvency II, this is also something what you can exploit and where you can bring forward your companies to make them more stable, to make them more professional. And this, in the end of the day, and now I come back, is very important for the stability of the insurance market. And the stability is the fundament for the trust we need from our customers to do our business properly.